says there are three main elements to the financial market. Government influences primarily the Federal Reserve System. So I don't know if you remember this, but on TV, they kept talking about the Federal Reserve System, how the interest kept going down. So we had that housing frenzy, right? It says the primary mortgage market and the secondary mortgage market. And we're going to learn about this because, right, for some people, it might be the first time they hear it. Okay. Thank you, Nedra. Thank you for letting me know. Okay. In this chapter, we will address every loan as a mortgage, regardless of being secured by a mortgage or a deed trust. Can someone tell me what is a mortgage? Let me see if you guys paid attention, chapter 13 with Bruno. I'm hoping he did a good job. So let me know, what do you, okay, Milton, yes, it is a lien, but what else is it? So the mortgage, okay, well, the borrower, so I have Amir lien against the home as collateral on the home. Yes, right? This is what I did for my morning class. So we have the house as collateral, and then we have the lender. What else do we have? Let's see if you guys were paying attention. What else do we have? You guys got to know this. You know why? Because it's going to be on the state exam. They're going to ask you questions. Yes, you have a promissory note, an IOU, okay? A promissory note. So we have the lender. Do we call the lender the bank? What do you guys think? Do we call the lender the bank? Yes or no? So Milton says yes. Anybody else? Louis says yes. Any no's? Yes. There's 30 people here, so I need to see like more answers. Katie Lee says yes. Nedra says loan company. Amir says yes, yes, yes. Let me tell you this, not necessarily. They're not the bank, they're the lender. They can work with different banks. Okay, so we always think that the loan comes from the bank. To a certain degree, yes. But if we're working with a lender, the lender is going to look at the best bank loans that they can give us. Okay, so we have the promissory note, we have the mortgage instrument. Okay. So is the mortgage the loan? Is the mortgage the loan? Please let me know. So I don't know if Shakira said no now. Okay, Saya says no. Milton says no. Michelle says no. So it is not the loan. It's the collateral, right? That the lender puts a lien on the house, and now it's a collateral. So if in case the house is foreclosed, they can cash in on the sale of the property. Now, what is a legal instrument? What is a legal instrument? And why would a mortgage and a promissory note be legal instruments? Thank you, Stephen, I'm sorry for your answer. Why is an IOU and a mortgage a legal instrument or a legal document? This is from chapter 13. It says they can be used as proof. Yes, I mean, you have to sign a promissory note saying I will repay the loan. So, well, The promissory note is not proof of ownership, right? You guys might not know this. We talked about the deed, the title as proof of ownership, but there's also have to be other documents at closing. So a legal instrument, one thing is that you can bring it to a court of law, right? And the second part is that it's negotiable. Okay? All legal instruments are negotiable. And so what happens, we're going to be talking about the secondary market and the primary market, and loans are sold on the secondary market. So they are legal instruments that can be sold on the secondary market. This was part of chapter 13, guys. So I want to make sure you guys are understanding this, because one, we need to know that the mortgage is not the loan. Okay, the mortgage is the lien on the on the lien on the house, which is collateral for the bank. In this chapter, we will address every loan as a mortgage, okay? Regardless of being secured by a mortgage or a trust of deed. So a conventional loan is not directly backed by the federal government. There's certain loans, and we talked about this in chapter 13, that there are certain loans that are backed up by the federal government. Can somebody give me one of the answers that one of the loans is backed up by the federal government? VA, which one else? FHA. Okay, thank you. So we said that loan to LVT, right? Loan value. So if we said that certain banks, certain loans cover up to 95% of the loan value. Do you know what loan that is? Take a wild guess. What are the loans that have 95 or almost up to 97% or even 100% of the loan is covered? So we have VA and FHA, of course, right? Especially the VA has 100% or 97% starting at 25,000, and then it goes down to 95,000 for the rest of the loan. So here, how much LTV do you think a conventional loan is covered? How much do you think? 80%. Good. Yes. And then you have that 20% as down payment. So on a loan that's 97%, you have a 3.5% down payment, right? Which one of these is a greater risk for the lender? What do you guys think? Which one is a greater risk for the lender? Because we need to understand what are loans, originating loans, how they originated, what they ask of the buyer. So yes, it is a conventional loan, but are you saying conventional is a higher risk? Not really, because the borrower is putting down 20%. Okay, anything below that, you might have to pay insurance. So I don't want to get ahead of myself, but I want you to understand this, how loans work. A conventional loan is not backed up by the government, okay? But if the loan, the payment is less than 20,000, right? 20%, I'm sorry. 20%, then you might have to pay some type of insurance. Okay, let's continue here. Says, a conventional loan is not directly backed up by the federal government, even if it's made by federally chartered lender. Okay, loans insured by the Federal Housing Administration, FHA, or guaranteed by the U.S. Department of Veterans Affairs, VA, has direct federal involvement, okay? And something that you might not know, VA loans, they pay a very low fixed interest. They don't pay the interest that conventional or FHA loans pay. So they might pay at a 2.4%, even if we're at a 7%, depending on where it's fixed. So VA loans for veterans are very, very important. But guess what? I worked with a VA loan. I'm telling you right now, it's hard for a seller to approve. Yes, because it has a lot of guidelines and FHA too that the house has to adhere to for it to be bought. So if a buyer comes with cash to the table, what do you think the seller is going to take? The cash, the conventional, FHA, or VA? What is your opinion? What do you think? Cash, right? Cash is king. So they might take the cash. I had to put, I'm not lying to you. This is back in January. We put like 10 offers or more in Verona, in Bloomfield, in Belleville, in Woodbridge. We were all over the place because we had to help this it's a police officer who wanted to buy a house and had been part of the Army, and he got the VA loan. It was really difficult for them to accept it. All right, so let me continue here because there's a lot of information, but I wanted you guys to know that the Federal Reserve System, the Fed's job is to keep credit conditions stable, help stop inflationary and deflationary trends, and make the economy good as possible. So what happened in the frenzy that we had of buying and selling homes, right? The Federal Reserve lowered the interest. So it made it possible for people who could not afford a home to be able to afford a home at the price that it was. Like a $500,000 home at a 3%, someone could afford it, right? So they had that buying frenzy. And then at one point when it was getting too crazy, then the Federal Reserve System highered the interest. The Fed controls the flow of money and interest rates in the market through its member banks. It does this by controlling the discount rate, which is the rate it charges for loans. It makes to them and their reserve requirements, which are the minimum amount of cash an institution must keep on hand. The Fed's discount rate affects the prime rate. So it's a different type of rate, right? Because the banks are the ones that have the prime rate, and then the Feds have the discount rate, which is also called the base rate. That member institutions charge for credit and loans to small businesses, and other types of loans. When the discount rate goes up, the interest rates on all the loans go up. So that's what I was just mentioning before. The Feds, they raised up the discount rate, all the interest went up, making it easier for businesses and home buyers to borrow money. The Fed's reserves requirements take money out of circulation. When reserve requirements go up, it's harder to get money, but lenders are better off. Okay, so it benefits the lender when the rates go up. When the economy is in a recession, the Feds buy Treasury securities on the open market to get more money into circulation and boost the economy. The Fed can also try to keep inflation in check by selling Treasury securities to reduce the amount of money in circulation. And we saw this, right? Through the pandemic, rates went really low, the lowest they've ever been for a very, very, very long time, okay? To keep the circulation of money going. So now we're definitely talking about the primary mortgage market. Can someone tell me what a market is? What is a market? What is a market? So Elizabeth says, Cruz, a place to sell and exchange goods. Anybody else? Or you can go and shop, buyers and sellers. Good answers. Anyone else? In the morning class, we have 15 people and everybody answers. I'm just saying. Right, Alexander? So Milton says supply and demand. Anybody else? The exchange of goods and service between buyer and seller. Thank you for your answers. They're all good answers. All right, so now we're gonna see what is this primary market. Okay, thank you. The primary market consists of lenders. Let me just get back to, I don't know how Bruno goes like this and it's like perfect. I don't know. So the primary mortgage market consists of lenders that originate mortgage loans. Does the lender charge you for the origination of the loan? Please tell me. What do you guys think? So Elvis says yes. Anybody has different? Yes, 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 yes. So yes, they charge you an origination fee. Okay. So savings and loans, commercial banks, mutual saving banks, life insurance companies, mortgage bankers, and credit unions are some of the lenders in the primary market. Even though they don't lend money directly to the customer, mortgage brokers are also a part of the primary mortgage market. I'm sorry, just let me turn off my phone. So I always say that my boyfriend calls me scam likely, okay? He's the only one that calls me back. That's damn scam likely, okay. So even though they don't lend money directly to customers, mortgage brokers are also part of the primary mortgage market. Instead, they help primary mortgage lenders find people to borrow from them, okay? Lenders can sell mortgage loans which produce income to make more loans. So the reason that there's a secondary market is because, I don't know if you noticed this, how many people here own a home, own real estate? I mean, you can go like this if you want. Okay, 1, 2, 3, 4. All right, so we have about 4 or 5, 6 people who owned a home. Have you, thank you, Amir, that was nice. In your statement that you get monthly, have you seen that your loan has already been sold to another company? Because you could have Chase Bank, and then when you get the new statement, they might be telling you that your loan was already sold to someone else, right? And in 2008, when we had the crash of the market, the stock market, loans, people, that's when they found out their loans had been sold on the secondary market. People didn't know that. Yeah, so loans don't want to carry so much debt because you know why? They want to make new loans. And in chapter 13, we talked about that people used to buy homes in cash, right? So the government says, let's make home affordability easier for buyers to buy a home. So then that's where all these creative loans came into place, where people were buying homes, okay? And that, believe it or not, the mortgage, the lenders who make these loans make a lot of money. It generates a lot of money for the economy also. Okay, so let me continue here. Lenders can sell mortgage loans which produce income to make more loans. And some lenders derive income from servicing loans for investors who have purchased the loans or servicing loans made by other mortgage lenders. Now we look at the secondary mortgage. A secondary mortgage market is a market where loans are bought and sold after they are originated. So they don't originate the loans in the secondary market. They are just sold to the secondary market. When money is scarce, Scarcity means when there's not enough money. The secondary market helps lenders raise capital to make more mortgage loans. The lender benefits by raising additional capital, avoiding interest rate risk on adjustable and fixed rate loans, and making a profit on the sale. In the secondary market, loans are pooled into blocks of several loans. Investors or other organizations buy securities representing these pooled mortgages. So they buy them in the secondary market, but when money is scarce, they have all different types of tactics, like pulling the money into blocks and several loans, buying securities to make more money. Government-sponsored enterprises. The major player in the secondary market is the government-sponsored enterprises. So we call it, in abbreviation, Fannie Mae, Freddie Mac, and Ginnie Mae. Guess what, guys? You will see questions on the state exam on this. So make sure you make a note of yourself and you understand what they are. The Federal National Mortgage Association, Fannie Mae, is a shareholder-owned corporation under congressional supervision. Fannie Mae buys a block of pool mortgages, okay? A lot of mortgages from a lender, then sells them as mortgage backed securities. Freddie Mac. What is Freddie Mac? Freddie Mac is a federal home loan mortgage corporation. It's a shareholder-owned corporation under congressional supervision. Government, right? Freddie Mac provides a secondary market for conventional mortgages. So they provide that secondary market so the loans can be sold in the secondary mortgage. GSEs have come up with standard loan application, credit reports, appraisals, and other forms that are needed for loans. They buy as well as clear rules for how the lending process works. Fannie Mae has a site for consumers, www.fanniemae.com, and a site for lenders at www.fanniemae.com/single family, and Freddie Mac at www.freddiemac.com. Ginnie Mae. Ginnie Mae is a government agency and a division of the Department of Housing and Urban Development. So we call this HUD. Ginnie Mae administers special assistance programs and guarantees, this is important, private officer investment securities backed by FHA insured and VA guaranteed mortgage loans. So guess what? When the lenders lend out loans that are FHA, VA, they can do so. Why? Can someone tell me why they can do that? We're talking about Ginnie Mae. Why can they do that? While you're thinking about it, I'm just going to get a little bit of water. Sorry about that, but my throat was dry. Okay, so why do you think? So did anybody write anything? Guys, you have to pay attention to chapter 13. So Ginnie Mae, right, backs up these loans. Yes, it's government backed, but why, guys? You got to think about that. Why? Okay, so when we talk about FHA, it's not that we're getting these loans that are being backed up. It says guaranteed mortgage loans. Doesn't mean that you borrow the money from them, but they insure. So when they insure, you pay PMI. Okay, they insure, but the buyer pays PMI. So we're saying that anything below 20%, most loans pay PMI. And VA loans also may pay PMI. Okay. So they're backing up the loan, but the buyer is the one that's paying the insurance. Initiating a mortgage loan. The process of initiating a mortgage loan begins when a borrower completes a loan application and submits it to a lender for evaluation by the lender's underwriters. So none of you have done a loan origination with a loan officer yet, but by my experience with the underwriters, okay, they check for everything. It's not like back in 2008. I have someone, excuse me, that I'm working with right now. We should be closing, knock on wood, right? Because everything can go wrong until we close. We're gonna close, and the underwriter is still asking for pay stubs, the last pay stubs before we close. And probably by the time next week rolls around, they're still gonna ask for pay stubs of that week, because now the lender wants to cover themselves from the buyer, losing their job or their income is changing. And he was asking me, why are they keep constantly asking me for bank statements and pay stubs? And I ended up talking to the lender, and it's all because the bank, let me tell you, the bank will lend you money, but they're always covering what? What are they covering? You guys got to start thinking about that. What are they covering? Yes, thank you, Elizabeth. Your assets, right? They're assets. So that's what the lender does. Who pays for the appraisal? Does anybody know who pays for the appraisal? The borrower. Exactly, the buyer. But who does the appraisal benefit? Who does the appraisal benefit? The buyer or the lender? The lender, okay. Anybody else? Michelle says the seller, somebody else says the lender. So the appraisal is for the loan. Because the loan, now you got to think about this. Once the appraisal is done, okay, let's say we have a house that the offer was put in for 400,000. Okay. The bank says, great, you put that offer in, but now we need to know what's the real value of the house. So they send an appraiser. Okay. So let me ask you, does the lender pay what you offered, or do they pay what the lender says the loan is? What they say the value of the house is. What do you guys think? Okay, I'll hold on to that. Anybody else? So Katie says the value of the house, the value of the house. So if the appraiser says that the house is not valued at 400, is valued at 380, what does that mean? What do you think? Yes, you might have to pay the difference, okay? And it means that the lender, so the bank will only lend 380. That is correct. Lend 380, but they will cover, depending if it's conventional, FHA, or VA, they will cover a percentage of the loan. So now think about it. So first the offer was 400. Now the appraiser says it's 380. Okay. And now we only cover 95% of the loan, okay, from the lender. And that 5% comes from the buyer plus the difference of the appraisal to the 400, then you have to pay that. So let's look at numbers. So we have 380, 1, 2, 3, okay, times 0.05. That's 19 down payment. Okay, so now from 380 to 400, That's another 20,000. Okay, so that's another 20,000 that the buyer has to come down, has to pay. So it would be 39,000. Now, think about this. The buyer wasn't expecting that. Okay, the buyer wasn't expecting that now the seller says, you know what, I'm not going down on the price. It depends on how motivated they are to sell, that maybe they'll come down to 380. But let's say the seller doesn't want to. Okay, so you got to think about this. You have to talk to your buyer and say, how, you got to tell me how much money you got in the bank. You got to be frank with me, because now you're advising them. Okay, and if they tell you, no, I only got 50,000 for, you know, the down payment, the earnest money deposit, and also for the closing costs, it might not be enough to cover the additional 20,000. So you need to be upfront with your buyer and look at the numbers. Now, there's something else that you can put in the contract. Maybe you don't know this yet, right? You can put a contingency. And does anybody know what a contingency is? Because we went over this on contract law. Yeah, Milton, they did waive the appraisal because probably they were paying in cash. You don't need an appraisal when you're paying in cash. So Kaylee says condition. Yes, right? So you have a contract contingency saying that the buyer will pay 20,000 or 10,000 above appraisal. Okay, so if they have 10,000, then you're still 10,000 short. Maybe the seller will allow you to buy it at 390 and bring it down, or not and take another buyer, or they can accept the 10,000 and that is it. So food for thought, food for thought. Okay, these are things that you have to be prepared, and you will learn them. I'm not saying that right off the bat, when you get your license, your first deal is going to be like this. It could be, it may not be, but I want you to be ready. Why? Because I said it in the morning many times, and I'll say it here. You have to be an investigator. Okay, your buyer, you got to have a serious talk with them. Let's talk about money. Let's talk about how much money you have. What are your intentions? What are your goals? What if you can't find what you're looking for? The variables. These are things that are important. Now we have completion here, okay? Does this make sense for you guys? Was this helpful? Just give me a thumbs up. It's okay. I don't need 100 yeses, but completion. I'm sorry. Oh, you missed the 18. That's okay. We're kind of reviewing here too. The application must be complete for the lender to consider it. The form must be signed and dated by the applicants and delivered to the lending institution. All right, we're talking about the application for the loan. The intention of the application process occurs when the lender receives the completed application package from the applicant. A loan application is considered complete when the borrower provides the lender with the first, this is what the lender needs from your buyer. Okay, and you could see a question on the state exam on this, okay? Let me ask you, can you buy a house with an ITIN number? What do you guys think? Can you buy a house with an ITIN? Okay, good. We have a couple of yeses. Yes, it depends on the loan and what the lender is asking from that buyer, that they have enough information for them to buy a property, because it's allowed by the government. It's a program. So as long as the program is in place, anyone who has an ITIN number can buy a home. But it's not as easy as we think, okay? It's not as easy. And I can't go into it right now, but it's a program from the government. Once the government says that program is closed, then no one can buy with an ITIN number until it opens up back again. So now we have the lender will ask the address of the property. Important. The loan amount requested. Income, estimated property value, name of the applicant, social securities, and if applied, if you're an alien, your alien card, right? Automated underwriting and scoring. What does this mean? For lenders, automated underwriting procedures can shorten loan approvals from weeks to minutes. Freddie Mac uses a system called Loan Prospector, while Fannie Mae has a system called Desktop Underwriter, which reduces approval time to minutes based on the borrower's credit report, a paycheck stub, and a drive-by appraisal of the property, okay? Through automated underwriting, prospective buyers can strengthen their purchase offer by including proof of loan approval. So if you don't know this, when they are trying to approve your client, your buyer, they go through this, right? The loan officer has some type of software that says, you know, by the information that you're giving me right now, and I'm putting in the system, you qualify for a loan. So we're gonna give you, while we're originating your loan, we're gonna give you a pre-approval. Now, a pre-approval doesn't mean that you're 100% approved, okay? You have to go through that loan origination, go underwriting, and now they're gonna investigate if you're really ready to buy, okay? Let me ask you, if your buyer has a loan already, okay? If your buyer has a loan already, I'm sorry, a pre-approval already, do you think that they're gonna get to the closing table? So I have someone that says no here in the class. It's Alexis. Yeah, that's right, because Bruno says Alexa. So let me tell you this. Just because you had your client pre-approved doesn't mean, even if their offer is accepted, guess what? Their loan can fall apart. Okay, that's why we have a contingency in the contract saying that if we cannot commit to the loan as a buyer, we are out. Okay, we are out of the transaction and we can get our deposit back. Okay, that's a contingency. So Jefferson, well, the pre-approval is that you're saying that you're starting your loan, right? That if you put an offer, that means that you are ready to buy. Now, I've had put offers when the realtor says to me, I need to see proof of funds. And we're not even finishing up the loan. So they're asking already proof of funds to see if you have enough money to buy the house. Or they'll call the lender, okay? Because sometimes I have to call the loan officer and say, can you talk to this realtor and let them know that my buyer is ready to buy and approved, okay? So the pre-approval is just a way of saying, yes, they're in the process of getting a loan. But it doesn't mean you're gonna get to the closing table. Some of these pre-approval, and loan originations, they fall through. Now, if you're serious about buying the house, then you can also put earnest money deposit. Does anybody know what an earnest money deposit is? We learned this through the brokerage chapter. Yes, it's a good faith deposit, but what does it do? Why do you put it in with the contract? What does it mean? Yes, many times it's non-refundable if you are in breach of the contract, okay? Or if you want not to go ahead with buying the house, then the seller keeps the money. So listen, if you have buyers, you got to think like realtors. If you have a couple of buyers coming to you and you're helping the seller, if I have three offers on the table, right? Because in New Jersey, our offers, once they're approved, they turn into contracts. Okay, other states don't do that, but our state does. So if our offer turns out to be into a contract, right? And we're looking at the offers. If I have Lydia is a realtor helping the seller. Lydia, if you see that the first offer, the earnest money deposit, okay, it's $40,000. The second offer has $10,000 and the third offer has $5,000. Tell me, which offer is more serious? The higher offer, right? Hope you people are not falling asleep on me. I can't really see your eyes. It's kind of far away, but I'm hoping everybody's still alive. So if we have an offer that has a high earnest money deposit, right? We know that that buyer is serious because they could lose that money if they don't go through with the sale purchase of the house. So think about that. And then not only that, we have to look at what else is in the contract too, right? So it's not something silly. But an earnest money deposit, like you said before, you're serious about buying that home, right? So let me continue here. All right. It says in lending money, a lender takes an enormous risk, right? Because a buyer could default. An owner can default on that loan. The main risks are that the borrower will fail to repay the loan and will damage the value of the property used as security. Also, the lender faces the risk that in the event of a foreclosure, the property sale proceeds will be insufficient to cover the lender's loss. So we think about this. This morning, I talked about, somebody asked me if your house is underwater, okay? So we have the house here, right? Maybe somebody paid $500,000 for it, and now it's appraised maybe at $350,000. The buyer couldn't keep making the payments. They lose the house, it goes into foreclosure, and maybe it's sold for $375,000, right? And now they're at a loss because they lend them, $495,000 to a loan that was $500,000. And it didn't cover enough. Probably maybe the creditors were the last to get paid, and that's it. Okay. Maybe the lien didn't even get paid off because there wasn't sufficient funds. So the lender gets paid, but now, is there any investors here that like to buy homes and sell them? You can raise your hand. Okay, so one. So what happens? You might be buying a property with what, Alexander? What are you buying a property? So, well, yeah, people might be renting, but you might be buying. Remember we talked about encumbrances? Right? You said encumbrances? So what are these encumbrances? Liens. We talked about there's superior and junior liens. Do you guys remember that? Right? So there might be taxes that weren't paid on the house. Anything that is superior lien is anything that has to do with taxes, water taxes, property taxes, federal taxes. So anything could be attached to the home. So now you bought the home for $375,000, but maybe you owe $30,000 on taxes, $10,000 on water. Okay. Maybe you own a mechanical lien of another $10,000. All right. So now you got to factor that in as an investor. What kind of house am I getting into? Okay. That's why investors try to buy a house the lowest price possible to make a profit. And if there's problems with the house, to pay those problems. I don't know if you know this, but there's a lot of homes on Zillow and other websites, other directories, okay, because they pull from the MLS, that have homes that are so beautiful from the outside, and then you look at the photos, and then what happens is they're unfinished. There's no sheetrock, there's no insulation, there's no bathroom, there's nothing, because they didn't have enough money to finish the home. So now they're selling it to recuperate the money they have lost. And in the housing frenzy that we had, some were very lucky, but other times those houses can sit there, right? We said real estate is not that easy to liquidate, right? It's illiquid. So Alexander says, is there any way to know about these liens? Well, tax liens, water liens, they're public, okay? But sometimes you have to do a lot of research to find that information. Okay, so let me continue here. It says qualifying a mortgage loan. Let me see, where am I still on the first page? All right, let's see where I'm at. Okay, second page. All right. To qualify for a mortgage loan, both the property and the borrower must meet the lender's qualifications. In addition, a borrower must demonstrate sufficient credit worthiness to be an accepted risk. You know that just because you opened an account and started your credit, you need some credit history, or your credit score can suffer. You want to be above 640, 740 is really good, and 800 is the best. But if you don't have credit history and the revolving accounts that you have, if you're paying them on time and you're not using 30% of the account, your credit might be like this, 580. Oh, why am I putting a dollar sign? So they need to look at that, okay? If the lender denies a request for a loan or offers a loan under different terms than those requested by an applicant, the lender must give the applicant written notice providing specific reasons for the action. So if they're denied that, usually they'll send, in the credit report, they'll tell you what is wrong with your credit, so you can start fixing your credit. Some people have student loans that they haven't paid. That hurts you guys. I don't know. The system should be different. You should work first and then see what you want to do in life and then go to school, because we pay a lot for those loans. In qualifying a property, an underwriter assesses the ability of the property value to cover potential losses. A lender requires that the appraised value of the property be more than the adequate to cover the proposed loan and costs in this evaluation. To further mitigate risk, a lender will typically lend only a portion of the property's value. So we call this LTV. Is the percentage relationship between the loan amount and the property value. If the lender's loan to value ratio is 80%, and we said that's conventional, the lender will only lend 80 on $100,000 home. The amount required in cash as a down payment is the difference between what the lender will lend and what the borrower must pay for the property. So if we have 80%, how much of a down payment will the buyer have to come up with? I got one answer in class. Anybody else? Yes, 20% as a down payment. Even if the borrower and the property qualify, a lender may, under certain conditions, seek additional risk protection by requiring the borrower to obtain private mortgage insurance. So like I said, if it falls under that 20%, they might have to pay PMI. This is often the case with loans requiring a small down payment, resulting in a high loan-to-value ratio. So what does this mean? When the loan's value ratio of coverage is 95% and above, okay, this is someone that's putting a small down payment. So we talk about risk, right? So the lender will put PMI. In qualifying the borrower, the lender must rely on 8 types of information to determine that the borrower has the ability to repay the loan. Okay, so here are 8 types of information that shows they have the ability to repay the loan. So 1, their current income or assets, excluding the value of a mortgage property. Current employment status, credit history, monthly payments for the mortgage, monthly payments being made on other loans on the same property, monthly payments for other mortgage-related expenses and debts. So when you're talking to your buyer, there's 3 components which I think are very important. Credit, this is before even the loan originates, okay? Job history, and what's the other one? Income. Okay, so when you talk to your buyer and you're pre-qualifying them before you even work with them, we want to know what that credit score is. Because if that credit score falls below 640, they might be able to buy with an FHA, might be able to buy, but their interest will be high. If they don't have 2 years of job history, it's very difficult, okay? And people had problems because of COVID proving that they were working. So there's a way around that. And your income. You have to have income. And you also have, like I said before, you also have to ask your buyer how much money they have saved up. That will tell you if they are ready to buy. And number 8, monthly debt payments compared to monthly income debt to ratio. This is very important. People don't understand that because this debt to income ratio, I don't know. Oh, yes, it's right here. Okay. It's explained here, so I'm going to continue. Income qualifications. Lenders want to ensure that the borrower has sufficient funds to make all required periodic loan payments. In addition to other housing expenses and debts, such as credit card payments. So we look at your debt, credit card payments, car payments. Most lenders use 2 ratios to determine an applicant's ability to repay a loan. And an income ratio, also known as a housing or front-end ratio, and a debt ratio, also known as a housing plus debt or back-end ratio. Please keep this in mind that the income and debt ratios discussed below may not be the most recent ratios used by FHA, VA, or other lenders, as different market conditions or needs may allow lenders to increase or decrease these ratios as needed. And this is true. These ratios here, I've seen them higher and lower. So income ratio establishes borrowing capacity by limiting the percentage of gross income a borrower may spend on housing costs. So we have housing expenses that are taken into consideration, include principal, interest, taxes, and homeowners insurance, and may include monthly assessments, mortgage insurance, and utilities. Most conventional lenders require that this ratio be no greater than 25 to 28%. In other words, a borrower's total housing expenses cannot exceed 28% of their gross income. For an FHA loan, the ratio is 31%, and VA guarantee loans do not use this qualifying ratio. We will see an example here. If a couple has combined monthly gross income of $10,000 and the lender's maximum income ratio of 28%, the couple's monthly housing expenses cannot exceed $2,800, okay? Because they need the rest to pay the loan. Debt ratio considers the monthly obligations of the income ratio plus an additional monthly payment the applicant must make for other debts, okay? Be paying the loan or other debts. So think about this. I said it before. I don't know if I said it here in the morning, but just because you can get up to $400,000 on buying a home doesn't mean you should go up to $400,000. You have to see what is your affordability to pay that loan. The lender will look specifically at minimum monthly payments due on revolving credit debits and other consumer loans. Most conventional lenders require that this debt ratio be greater than 36% for an FHA-backed loan. The debt ratio may not exceed 43%. The VA uses 41% and a variable residual income calculation. So you can see a question on the state exam about these ratios and a calculation, okay? The FHA and VA include the debt figure and obligations costing more than $100 per month and any debt with a remaining term exceeding 6 months. Using the 36 debt ratio, the couple whose monthly income is $10,000 will be allowed to have a monthly housing and debt obligations of $3,600. 10,000 gross income times 36 is 3,600 expenses and debts. Okay, so now we're looking at the debt ratio here. With FHA, it's much higher. You can have more debt. Lenders also consider an applicant's income stability and calculate the maximum monthly payment each way and allows only the lower figure. For instance, based on the examples mentioned above, a couple with a monthly income of $10,000 facing traditional lending ratios of 28 and 36 will be limited by the lower number after calculating other debts, if any. With no debt, the maximum PTI payment would be $2,800, front-end ratio of 28%. So they're considering the back-end ratio and the front-end ratio. With a car payment of $600 and $300 in a minimum credit card payments, the maximum PTI would be $2,700. Because now you have the car and a credit card, okay, that you had debts on. So it says the back end ratio 36% minus 3,600 minus 600 minus 300 in credit cards gives you 2,700 a month PTI. Okay, that's what we saw here. VA guaranteed loans also require a borrower to meet certain qualifications. And this right here, most of the time, the loan officer is the one to calculate this on the third-party software. So just for your understanding, okay? There's a back-end ratio and a front-end ratio. VA guarantee loans also require a borrower to meet certain qualifications based on the net income after paying federal, state, and Social Security taxes. Housing maintenance and utility expenses, such residual income requirements vary by family size, loan amount, and geographical region. Okay, so let's continue. Income stability. So these are all the factors that they look at. Goes beyond income and debt ratios. Important factors are how long the applicant has been employed at a present job, and we talked about this, how frequently and for what reasons the applicant has changed jobs in the past. Okay, they can change jobs. From what I know, okay, as experience, if you're still in the same field, it's counted as job history. But if you change fields, it's like changing jobs, and your job history might not be enough to cover for the 2 years. How likely secondary income such as bonuses and overtime is continued on a regular basis? This I know. They calculate your overtime. So I've been asked to bring pay stubs to look at overtime and how much overtime, and if it's consistent, to be, it says on a regular basis, to be as part of the income. How educational level, training, and skills, age, type of occupation may affect the continuation of the present income level in the future. Cash qualifications is important because the lender will lend a portion of the property's purchase price based on the lender's loan to value ratio. Okay, a lender will check to see if a borrower has enough cash, what we talked about, to make the required down payment. If some of the down payment money comes from a family member, okay, because people try to be smart, right? They want to like let the lender know they have money, so like just they start putting money in the bank. You can't do that. You have to prove through your bank statements that that money's coming in consistently, right, to make up what you're saying that you have in the bank. But a friend can give you a gift. So many times we've been faced as realtors trying to help our buyers find a way that they can show they got a gift from someone, right? So we'll ask them, do you have someone that you know that can give you $10,000 as a gift to put it as part of the purchase price, right? This is a gift that they don't have to pay back. It cannot be something that they have to pay back. All right. The lender may ask for a letter from the donor stating the amount of the gift that the borrower does not have to pay it back. The lender will count this as another debt obligation and adjust the debt ratio to reflect this. This can make a lender less willing to give you money. Okay. The net worth of an applicant reveals to a lender the applicant's financial reserves, the value and liquidity of assets, and the extent to which assets exceed liabilities. These details are significant to a lender since they indicate the applicant's ability to maintain debt payments in the case of a job loss. And I had talked about this in the morning. I said, maybe you have 6 months of an emergency fund, okay, or up to a year. I don't know how many people are saving. If you are saving, raise your hand. Are you saving money? Okay, we have a couple of people saying that they save money, but the government says we don't save enough. And that's very true. People, they don't have enough saved in the bank, but there are people who save. So in the case of a job loss, they're going to look at those assets. Credit report and credit score must be obtained on any applicant who submits a completed loan application. The credit score will contain the applicant's history regarding any outstanding debts, payment behavior, timelines, collection problems, legal information of public record, lawsuits, judgments, bankruptcy, divorces, foreclosure, garnishments, repossessions, and the defaults. Payment issues and legal actions are likely to result denying the application unless the applicant can prove an acceptable explanation of my mitigating and temporary circumstances that cause the problem. If the lender denies a loan based on a credit report, the lender must notify the applicant in writing that the applicant has a right to a statement of reason from any creditor responsible for the negative report. Credit reporting is a computer-based method of assigning a numerical value to an applicant's credit that is a statistical prediction of the likelihood of a borrower defaulting on a loan. Loan commitment happens when a lender underwriters have qualified and pre-qualified an applicant based on complete application, and the lender has decided to offer the loan. This is different from a pre-qualification, which simply estimates the maximum a borrower might qualify for. And we kind of talked about this. The underwriter, they have to see if the applicant is able to get a loan, if they qualify for what we've talked about before, if they have income stability, right? If their debt is not high, if they have income, and so on and so on, credit history, job history, payment, whatever they're paying. Let me continue. Their credits. So now at the end, towards the end of the closing transaction, okay, there's a loan commitment. Can someone tell me what they think the loan commitment is? What is a loan commitment? Because I've been talking a lot, but I haven't asked for any answers. What do you guys think it is? Try not to read it. So thank you, Janice. Thank you, Jefferson. And so a fee approval with conditions. Anybody else? Policies. Is it Zabdi? Am I saying it right? Okay, good. Anybody else? Something that will hold you to the loan, maybe, means they vetted you and you're good. Steven, you're smart. Keep it simple, right? Has anyone heard the acronym KISS? Has anyone heard that acronym before? It says, keep it simple, stupid. That's what it means. It's something that you can use. Keep it simple, stupid. All right. So it says a loan commitment happens when the lender's underwriters have qualified and pre-approved an applicant based on the completed application, and the lender has decided to offer the loan. So we're good to go. It's like a marriage, right? We're ready. We're on the altar. We're putting the ring. Now we're committed, right? We said yes. We said yes on TV is yes to the dress. Yes to your husband. And when the lender is yes to the loan. Okay. All right. So let me continue here. This is different from a pre-qualification, which simply estimates the maximum a borrower might qualify for. So I read this already, but that's what it is. You're committing to that loan right before you go to the closing table. Okay. This is different. I read that. I'm sorry. Among other requirements, lenders must verify credit and employment information at the last minute before closing, a requirement that often takes borrowers by surprise. So guess what? We don't close until the buyer gets the keys, okay? Because at that point, the lender's still calling the workplace, the job. Hey, is this person still working there? Because they could have lost their job and not said anything to the lender, right? So they're even calling at the last minute before the closing to see if this person is still working. So now we have a closing loan. So now we said, yes, we committed, we put the ring on it, we're happy, we kissed, whatever, right? So now we're closing the loan. Typically, the closing of a mortgage loan coincides with the closing of real estate transaction. At the closing of a real estate transaction, the lender often deposits the funds amount with an escrow agent. Does anybody remember what the escrow agent is or what an escrow account is? Lacey's like, keep it simple, stupid. So you like that one, Lacey? Did you hear it before? I do design, so I went to school for design. So yeah, for multimedia, graphic design, and visual communications. So every time the teacher would say, Jen, keep it simple and keep it stupid. And it's actually keep it simple, stupid. All right. So what is an escrow agent or an escrow account? What do you guys think it is? Because you might see a question on the state exam. Yes, it's a third party, but guys, think about this. When you go to the bank, do you have a personal account? Yes, right? Or you might have a business account if you have a business. Yes, it's a third party that holds the funds, okay? And who can most likely be an escrow agent? Broker, escrow company, title, who else? No, not a listing agent, not a lender. It has to be a third party, a lawyer, attorney. That's correct, okay? And they do the disbursements, okay? The borrower deposits the required money with the escrow agent, executes the final document, and receives signed copies of the pertinent documents. So here in New Jersey, typically, we use the title company, okay? And they prepare all the documents and they hold the money to be dispersed at the end of the closing. So it says the borrower deposits the required money for the escrow account. The escrow agent might ask, the title company might ask the borrower to bring a certified check. Okay, when we say we're paying in cash, we're not taking the actual money to the attorney in a briefcase and opening it up, okay? It's not like the movies. It's a check, a certified check from the bank saying that the funds are there, okay? It says executes the final documents and receives copies of all the pertinent documents. The mortgage property title is transferred and documents in accordance with the applicable legal process at the time of closing. The borrower receives a packet containing copies of all transaction-related documents. So at closing, this transfer of titles when all the documents have been signed and they're put in, and I've seen this in a packet when they're buying the house, when they're closing on the transaction. Okay, so we have types of loans. Let me just quickly see where I am and how many more pages. Okay, so we'll do this. Types of loans. So we talked about this before. We have the conventional loan. Conventional loans are considered the safest, right? Because now the lenders are always taking a risk on the borrower because their low loan to value ratios. That's why the ratio may be 80% of the property's value or less if the borrower makes a minimum of $20,000 payment. They can give more than $20,000, but typically if they give a $20,000 payment, it's a low loan to value risk. Because that repayment is contingent on the borrower's ability to pay, the lender assesses both the property and the potential borrower thoroughly. In deciding a loan amount, the lender relies heavily on the property's valuation. Information from credit reports, the buyer's credit score, and other indicators such as qualifying ratios, job history are crucial for determining the buyer's willingness, ability to pay. With a 20% down payment and a conventional loan, no additional insurance or guarantee is often required to safeguard the lender's interest. A loan with a down payment of less than 20% typically requires private mortgage insurance, what I said before, less than 20%. A conventional loan is not insured or guaranteed by the government. In contrast, FHA insured and VA guarantee loans are. Nowadays, the secondary market has a substantial impact on borrowers' eligibility, collateral rules, and lenders' documentation practices because loans must meet strict criteria to be sold to the Fannie Mae and Freddie Mac. So before I continue, here in the conventional loan, we have that also that MIP or PMI. I'm sorry, private mortgage insurance PMI. Say that again, Alexa.
Good question. So the private mortgage insurance, does that apply to the conventional loans?
Yes,
Okay.
yes, it applies to the conventional loans when they don't pay that 20%. It's lower than that because now it becomes a risk to the lender. Okay, so remember, FHA and VA loans, it's not that the secondary mortgage helps you borrow the money. It is not that. They insure if you default. Nowadays, the secondary market has substantial impact on borrowers' eligibility, collateral rules, and lenders' documentation practices because loan must meet strict criteria to be sold Fannie Mae and Freddie Mac. So for a loan to be sold on the primary market, it has to go through Fannie Mae and Freddie Mac guidelines. The Federal Housing Finance Agency publishes Fannie Mae and Freddie Mac maximum loan limits. Each county or equivalent has specific loan limits, and high-cost areas may have lower limits. Okay, so this is what I was talking about before. Before it's even sold on the secondary market, they have to look at that loan. Non-conforming or jumbo loans are loans that go over the stated limits. These loans can't be sold, but the lender may hold them in his or her investment portfolio, along with other loans that don't meet FHA, VA, or Freddie Mac and Fannie Mae or Freddie Mac underwriting rules. If a real estate agent knows that a portfolio loans are possible, they may find this information useful when working with a borrower in an unusual situation and a flexible lender. Private mortgage insurance. Private mortgage insurance, and you might see your buyer say, how come I'm getting this low down payments, low interest rate, and now I have to pay PMI? Sometimes, if you really look at a conventional loan and then an FHA loan, you might see that you're paying more on an FHA loan on your monthly mortgage than you would be on a conventional loan. Maybe you didn't know this, but I've seen it when I'm working with my buyers. At the closing, the borrower purchases an insurance policy that provides funds to the lender in the event the loan defaults. This enables the lender to take on more risk, allowing the loan to value ratio to be higher than with other conventional loans. PMI protects the top portion of the loan, which is typically 20 to 30% from borrower default. This means that if the property sold at foreclosure sale for less than the loan's outstanding balance, PMI will usually cover the difference. Okay. While PMI is in effect, the borrowers must pay a monthly premium or fee, which may be included in the loan payment. Does anybody have an FHA loan here who's bought a house? Milton, is not a gap insurance. It's backed up by the federal government, okay? Elizabeth says, I do. Okay, so do you pay PMI, Elizabeth? Yes, okay. So without telling me the loan, how much is do you know how much is your PMI? Private mortgage insurance.
For conventional?
For conventional,
Right,
FHA.
Oh, really?
Yes.
What's MIP? That's not the FHA?
We'll get into that
yeah.
because people, we have MIP and PMI, and they interchangeably use PMI for both. on the, if you go to be, like not here in the school, you're out there, everybody calls it PMI, even though it's MIP. Yes. So she says, I don't remember. How dare you come to class and not remember? All right. So let's continue. It says, while PMI is in effect, the borrower must pay a monthly premium or fee, which may be included in the loan payment. The Owners Protection Act of 1998, HPA, requires lender to terminate PMI payments automatically if the borrower has at least 22% equity in the home and is current on mortgage payments. The 22% of equity set by HPA as the point of which PMI can be canceled is based on the homeowner's purchase price if the borrower's improvements or market appreciation have increased the value of the home. The borrower must contact the lender to request the PMI release, and an appraisal at the borrower's expense may be required. Okay, so now we're gonna look into the FHA insured loans. When does Bruno usually go on break? 7:30? 7:30? Okay. So we have FHA is a Department of Housing and Urban Development Agency, HUD. It does not lend money, and this is what I was saying before. It only insures, but rather insures long-term permanent loans made by others. The lender must be FHA approved, and the borrower must meet certain FHA requirements. Furthermore, the property used to secure the loan must meet FHA requirements. So that's what I was telling you about. If the loan is FHA and the house does not pass the requirements, they cannot buy the house. The FHA guarantees that the lender will not incur significant losses in the event of a borrower default. FHA provides insurance and charges the borrower an insurance premium to provide the security. FHA loans typically have a higher loan-to-value ratio, and that's when we said they can cover up to 95% or 97%, than conventional loans, allowing borrowers to put down less money. The basic FHA insured loan program for 1 to 4 family residential properties is Title 11, Section 203B. The following are some of the program's features. So now we're going to look at this because some people get confused. Like, is Alexa? Alexis. I'm going to have to call her Alexa because now it's stuck in my head. All right, so we see MIP. And with conventional, we see PMI. Okay? So it says here, the FHA determines how much mortgage insurance must be provided and charges the borrower an appropriate mortgage insurance, MIP. Now, what I was telling Alexis is that everybody outside of the school, people call a mortgage a loan, but now we know it's not, and they call PMI, whether it's MIP or PMI. But for FHA and for the test, FHA is PMI. The initial premium is payable at closing or is added to the borrower's loan balance and finance. Further, annual premiums are charged monthly. The amount of the premium varies according to the loan term and the applicable loan-to-value ratio. Borrower default. The FHA reimburses the lender for losses due to default by the borrower, including cost of foreclosure. So that's what they cover. Appraisal. The property must be appraised by an FHA-approved appraiser. The property must also meet the FHA's standards for type and quality of construction, neighborhood quality, and other features. Maximum loan amount. The FHA has set maximum loans amount over 80 regions. Borrowers within a region are limited to the loan ceiling amount in effect of the region. In addition, maximum loan amount is restricted by the loan-to-value ratios in effect. Okay, it's restricted. So they look more at the loan-to-value ratios. The maximum FHA-backed loan a borrower can obtain will be the lesser of the original ceiling amount or the amount dictated by the loan-to-value standard. Calculations are based on the lesser of the sales price or the appraisal value. Okay, so what does this mean? You're gonna get the loan to value standard, okay? So they look at the sales price and the appraisal price. So they're based on the lesser. So if the sales price is 400,000, okay, but the appraised value is 450, what number are they going to take into consideration first? What do you guys think? Let's see who's paying attention. So Jefferson's the lower. Milton says 450. Lacey says 400. Zabdi says 400. Michelle says the lowest. Correct. It says it right here. The lesser, whether it's the sale price or the appraised value. So the appraised value is higher. Okay. So down payment requirements. The minimum down payment for an FHA-backed loan is based on the lower of the appraisal value or sales price. The present requirement for residential loans is 3.5%. Maximum loan term, 30 years is the maximum length of the repayment period. Prepayment privilege, we saw this on chapter 13. The borrower has the right to pay off the loan at any time without penalty, provided that the lender is given prior notice. The lender may charge up to 30 days interest if the borrower provides less than 30-day notice. Assumability, we talked this about in chapter 13. When you get the CD, the loan will say if it's able to be assumed by someone else. FHA-backed loans on owner-occupied properties are assumable if the borrower is qualified. Lenders and borrowers should check the FHA for current requirements. So you have to see within the state, and the lender should tell you who qualifies and what are the requirements. Interest rate. The lender and borrower negotiate the interest rate on an FHA-backed loan without any involvement by FHA. Points and fee cost. The lender may charge discount points. Did you guys go over that with Bruno? Discount points? Yes, no, maybe so. Test, Milton says test. Okay, I'll take that. Yes, okay. So the lender may charge points, discount points, a loan origination fee, and other charges. These may be paid by a buyer or seller. However, if the seller pays more than a 6% of the cost normally paid by a buyer, the FHA may regard these as sales concessions and lower the sales price on which the loan insurance amount is based. We will learn more about concessions when you start in the field. Okay, thank you. In addition to section 203B, loan programs, FHA offers insurance cover for other loan products such as homes, home improvement loans, subsidized loans for low and middle income families, loans for condominiums, and more. So as a contractor, I have helped FHA borrowers with home improvement loans to fix their house. VA guaranteed loans. To qualify veterans, the Veterans Administration Department of Veterans Affairs provide loan guarantees. The VA, like the FHA, does not lend money except in limited circumstances where other financing is insufficient. Instead, the VA particularly guarantees permanent long-term loans originated by VA-approved lenders on VA-compliant properties. The guarantee provided by the VA allows lenders to make loans with higher loan-to-value ratios than otherwise possible. So you can even see 100% of guaranteed on that loan, 100%. Okay, some of them are 95%. could be 97%, especially on the first 25K. The bank will give you 97% and then 95% on the rest of the loan. Does the borrower have to put any down payment on a VA? You tell me. So you guys are saying no. Not usually, yes. So the borrower does not pay a loan guarantee premium, but does pay a VA funding fee at closing. So they don't pay MIP. Borrower default. Where are we? So we could take a break. Okay, maybe I'll do it at the end of. What page is that? 166. Okay, let me just finish this. Eligibility for veterans. And I like this because the other book we had, we really didn't have much on veterans. Thank you. Is Connie? That's the name, Connie? All right. A veteran must apply for a certificate of eligibility to find out how much the VA will guarantee in a particular situation. A veteran who meets any of the following time and service criteria is eligible for a VA guaranteed loan. So here we go. 90 days of active service for service people currently on active duty and veterans at least 90 days of active service during World War II, Korean War, Vietnam conflict, and the Gulf War, which extends to the present time. Okay, Emily, no problem. A minimum of 181 days of active service during inter-conflict periods between July 26, 1947 and September 6, 1980. Eligibility, 2 full years of service during any peacetime period since 1981 for officers, or the full period at least 181 days for which the veteran was canceled or ordered to active duty. Eligibility, 6 or more years of continuous duty as a reservist in the Army, Navy, Air Force, Marine Corps, or Coast Guard, or as a member of the Army or Air National Guard. Now, maximum loan term. The maximum loan term for a 1 to 4 family, and I want to state this here, 1 to 4 families residential, right? Anything above 5 and up is what? Okay, I got an answer. Anybody else? Just want to see if you guys know. Okay, all right, good. Commercial.